Global Business Report on Arise News. South Africa's gross domestic product in the second quarter of 2020 contracted by a massive 51% on an annualized basis, reflecting the immense damage done to the economy by the COVID-19 lockdown. Pushes the South African economy even deeper into recession after GDP growth for the first quarter was recorded at a contraction of 2%, following drops of 0.6% in the third quarter of 2019 and 1.4% in the fourth quarter of 2019. It's the fourth consecutive decline in quarterly GDP since the second quarter of last year. South African analyst Clive Ramathibela joins me now from Johannesburg to discuss these matters. Clive, you're welcome. Gosh, this is a pretty historic figure. Unfortunately, it's not historic in a good sense. What's your take? What's the mood with these figures that have just come out where you are?
Yeah, I mean, it's been a very tough one, and it's been really interesting to see how the numbers have come out. Look, I think that I was expecting it to be a bit worse than what we've seen, to be honest with you. Fortunately, we were helped by a very strong resources sector that managed to sort of trickle down after it came back in the stage 3 of the COVID-19 pandemic, where we were under lockdown. So that sort of saved a little bit more percentage points when it comes to how our GDP looks. And it's unfortunate that it is the fourth quarter. We are in a fully fledged recession, and it's getting worse and worse. But here's the story that we need to remember as well, is the following. One, the US didn't do any much better itself. You know that the US lost about 32.1% of GDP in the same period. We had the UK as well, didn't do relatively well. They were down by 35.2% in the same period as well. The only people to actually give a positive annualized value of their gross domestic product was China. They were up by 3% in the same period in terms of their year-to-year performance. So what actually happened in this particular sense is that we saw a shrink. Obviously, the two sectors that I think definitely took a nosedive, that is obviously on the resources sector. They brought us about a 57% decline in that. And then you had the other sector that was quite interesting to see, that the industrial sector as well took a real serious nosedive. But it's no surprise that the agricultural sector sort of sustained us in that period in the second quarter, simply because they provide obviously what was required to be, what was classified as essential goods. So we had people continuing to buy groceries. We had more people at home, so they bought more groceries. We have companies in the pharmaceutical industry that relatively did well. The likes of Clicks, for example, the likes of Discount did very, very well. That online sales went up 400%, to show you just how strong online was taken up in that period as well. So all these are factors, obviously, that are very, very important. The worrying, the concern is that we estimate from an economic perspective that for South Africa to return to a better economic outlook, a better trajectory, we expect them to spend close to about 3.5 trillion rand for them to do so in the next 3 to 5 years. To do that, they need to rely on a very heavy fiscal outcome, meaning that the amounts that's been collected from the tax perspective must be able to finance this new infrastructure development project that they've engaged in, that they're saying it's going to be the recovery, a remedy for them to get back on their feet. Unfortunately, because there's less taxpayers, we've lost close to about 2.5 million jobs. We have a less 20% of the people who are collecting taxes, paying taxes. And we have 67% of South African companies that are actually paying tax regularly on a regular basis. So those factors are going to make it very, very difficult for them to come out of this space unhinged. But for example, now we're going to be revising their annual expectancy for 2020. We're expecting a GDP decline of 7%. I think now after this result, it seems like we're looking at anything between 9 to 11% of GDP loss for 2020.
Thank you for that, Clive. Yeah, I was about to ask you that because the economists that were polled were looking at about 47% for Q2, and this ended up being 51. So I was going to ask you if you think that 7% figure for full year 2020 could actually be worse at the end of the year than what's being projected. But Clive, I do have to ask you something. Like right before you came on, I had the CEO of the Nigerian Economic Summit Group, and he was pushing back on the fact that a lot of Nigerians here, we contracted in the second quarter by 6%. But a number of Nigerians tend to mention the US, the UK, okay, they were worse. And you just did the same thing when you mentioned the UK's contraction in the second quarter, the US. Is that a good idea for us in the emerging markets in Africa to be looking at the Western world and saying, oh, well, the US dropped by worse, the UK dropped by worse, so maybe it's not that bad. Isn't that a bit dangerous?
I think that's an unfair question you're asking me, but I'll respond to it.
Okay.
As markets, as economists, you have to do some form of comparison. And it's always good to compare with the best in the world in terms of whether or not we are meeting the threshold to make sure that we are more competitive and we can actually reach out and do more. If you look at the South African response, for example, to COVID-19, it has been relatively strong. The actual second peak we've reached already. We are seeing more. We are seeing a 90% recovery rate. We are seeing the death ratio decline, and that is far much better than the US, the UK, and some parts of Europe. So in a sense, it's interesting that despite the fact that we are sitting with South Africa in the second quarter, sitting with a negative 51%, the fact that we responded better means that we were supposed to be hit harder. So I think that the answer to your question is, yes, it's relatively fair to compare with the best in the world. However, it does not mean that we're immune to the factors that could affect how our businesses and how our economies grow, because simply they are not in the same stable, obviously, and they cannot be put in the same basket. And it's unfortunate that we can't. But you're making a very good point, and I'm agreeing with you, but I'm also saying, who do you compare yourselves to? Because the most reliable agencies, the most reliable information that we have comes from these Western countries, and they provide us a little bit of a stethoscope, something to actually be able to measure against, as opposed to, I'm not making any controversial statements, but, we need to, if you compare it with the likes of Russia, which is also an emerging market, it's very difficult to make a comparison. Oranges with oranges, bananas with bananas, apples with apples, with an economy that you don't know if the numbers that they're projecting are actually the reality of what's happening in the country. So I think that's the fairest I can give it.
That's fair. That's fair. We've only got about a couple of minutes. I have to ask you about the ban on alcohol sales. A number of restaurateurs in South Africa, their alcohol sales for their restaurants account for about anywhere from 40 to 50% of their total sales. So with what we're seeing with these GDP numbers, is the government going to reverse course and allow alcohol sales? I know it's a safety issue. If you can, briefly, about a minute or so.
I hope you're not saying that South Africans are a drinking nation. Of course we are. But, the truth of the matter is that those two, the alcohol ban and the cigarette ban, definitely affected us. And it's no surprise, because even though it's only about statistically 27% of the South African population that's drinking, and about 17.5% that is smoking, that the contribution that those tax collection does to the bottom line of the GDP is massive. And that is why when you talk about restaurants accumulating about 40 to 50% of that income, that means that those companies have lost. And that's why they were forced to actually open alcohol and lift the ban because of those kind of circumstances. But here's something to think about. A market emerged in that period of the lockdown when the and I'm not going to reveal who was selling, but a market emerged which was undercover, that was able to flourish during that time. Even though as expensive as they were in the cigarette market, people still continue to smoke in South Africa, and people still continue to drink in South Africa. So the loss, and I know people will say, oh, but regulators, but that loss will never be made up again because that money is gone and the expenditure of it is already gone.
Point taken. Clive, we run out of time. Point taken, though. Clive Ramathibela, thank you so much for taking us through South Africa's second quarter GDP. Have you back again. You're watching the Global Business Report here on Arise News.